Well, we've seen a bit of a bounce actually from the low point of the day. A couple of stocks are fighting for the Nifty. Axis Bank, that's the one that's gained close to around 0.5% odd. It was trading in the red. It's pulled back a tad bit, so keep an eye out on that one. And a couple of these other IT companies. Infosys is cutting its losses now. Tech Mahindra as well is cutting its losses. And that's why we've seen a bit of a pullback from those lows of around 10,762 odd. So keep an eye out on these stocks. But the big drag today really is TCS. A contribution chart will tell you that. That in fact is dragging the index single-handedly by close to around 12 points. Well, Rima, TCS valuation-wise, it trades at a bit of a premium, so the scope for disappointment is obviously there out there. But the numbers didn't look good. What about the management commentary? Fill us in.
Well, on the numbers, it was only the margins which actually disappointed. The rest of the numbers look good. So on the margin front, the key reason was an increase in the subcontracting costs and local hires due to the talent crunch. So as a result of this, their margins came down by 90 basis points on a quarter-on-quarter basis. And this is not a one-quarter issue. In fact, brokerages believe that this higher cost of doing business is going to impact them even going ahead, and the industry as well. So which is why CLSA has cut the margin estimates from FY19 to FY21. And this is driving some EPS cuts. So CLSA reiterates a buy rating on the back of industry-leading growth for TCS, but they brought the target price down to 24.60, while Kotak has a reduced rating on the stock on the back of stretched valuations, and they too have lowered the target price to 18.25. So here's what the management had to say. There are two key issues now for, not issues, but two things that you need to bear in mind when you look ahead for TCS. One, FY19, the company is going to see a double-digit growth. Can that continue next year, given there is macro uncertainty, Brexit, trade tensions, etc.? So that is one question. And secondly, this higher cost of doing business. There is, the management acknowledged there is a talent shortage. There is a skill shortage, as a result of which you have to hire more people on site, which means the cost goes up and therefore the margins go down. This is an industry problem, and this cannot be resolved in one quarter. Even if you want to try and pass it on through pricing, etc., it will take time, which means in the medium term, there is a risk to the cost structure of the industry per se. So these are the two big questions for the IT industry per se. So here's what TCS had to say. They started off by saying, yes, there is a skill shortage. The company is taking steps to address it. And although they're not meeting the margin guidance, but they didn't meet it at least in this quarter, they said structurally there is no issue in terms of us meeting the guided band. It may not happen in the near term, but in the medium term, they're confident. Also, when it comes to double-digit growth for next year, they're saying barring any unforeseen circumstances, there is no reason to believe why they should not be able to achieve it. And the key reason is because the company's order book is accelerating, and it's a broad-based order book, unlike in the past when it was concentrated in a few sectors. As of now, it's too early to talk about the macro concerns. Yes, there is some softness in UK BFSI. They've seen cautious spending in UK and continental Europe, and this is because clients are waiting to see which direction Brexit takes. Also, the company, said something very important on this whole growth and margin trade-off. They said that right now their priority is investing for growth and capturing the demand rather than defending a particular margin level. We'll get, the management bite as well on this, but they clearly seem to suggest that in the near term there is demand and we want to capture it, and it seems to suggest it could be at the cost of our near-term margins. And, the demand was so strong that they actually had to hire subcontractors. Earlier, the plan was that, we'll create a local bench. But forget that, they've not managed to create a local bench. But, they had to actually hire subcontractors to meet their demand. So these are some of the takeaways. So upbeat on demand. Management is not too worried about the margin picture, though the street is quite worried. Let's listen in.
The BFSI sector in the UK and in continental Europe, there is some softness that we have seen. One of the things that we see in the European market and the auto manufacturers, their focus is a lot more on electric vehicles today and connected cars. So a lot more R&D spend is happening, as opposed to conventional spend in the other areas, right? So I think it's a question of time before they form consortiums today, in terms of electric vehicles, etc. One of the development that we see is there's a consortium to share the costs of the platforms that are getting developed. So all this, I think, it will take time. But, in the next 1 or 2 quarters, I think they should iron out some of those directions, and then growth should come back.
In terms of order of priority, investing for growth and participating on demand and backing the opportunity that we see in the field is a much higher priority for us than defending any given margin band. But we are quite confident that having participated, having invested, the structure in the industry is such that we should be able to get back into our desired band over a period of time. We were planning to build on a bench, but actually the demand is really even stronger than what we had originally thought. So the bench creation has still not happened. Pretty much, and that is why you see the subcontractor one, because it's coming, it's a much faster capacity that we can bring on stream and immediately capture the demand on hand.
There is a skill, what you call shortage, right, which is there. So all these are part of that, but we have been taking several steps to manage this, and some of them take some time. So I think one should look on it on a longer term basis. We've said that yesterday as well. On a 9-month basis, our margins are still 25.7. So it is not that it has moved so significantly, but I think we will stay very focused on it.
Velocity of the deals and the volume of the deals, both are increasing, right? Thanks to the ability of the customers today to seamlessly integrate many of these technologies, right? And consequently, there is an upward revision of, in terms of the deal size. It's upwards of, let's say, 15 to 20% in some of the deals, some of the opportunities.
Structurally, we don't believe that this is altering any cost structure on a long-term basis. So we stay very focused on the overall revenue growth, plus with the strong margin performance. Unless currency is a big truant, we should be able to definitely improve from where we are today.
Okay, India is underperforming while the Asian markets are trading in the green.